So we are saying that what we are looking at is the petroleum industry framework. So we're looking at the collection, the computation of tax revenue on petroleum industry. So the first thing we look at is who has the power to collect tax revenue from oil companies or from oil producing companies. So we say the administration and the assessment and the collection of tax revenue from petroleum companies is to be collected by the federal government and through their agents, and that agent is the Nigerian Revenue Service rather, the Nigerian Revenue Service. So let's look at the accounting period. The accounting period. Accounting period. Now, we're looking at the accounting period. Now, when we are looking at the accounting period, it means that we are saying that how do we determine the assessable profit of petroleum companies? Are we together now? How do we determine the assessable profits? That means we are looking at which period are we supposed to charge their profits to tax. That is what we are looking at now. So we're looking at the accounting period of petroleum companies. So let's now look at it now. We have let's now look at a company now, a petroleum company that is commencing their operation. A petroleum company that is commencing their operation maybe in a particular year now. That means for you to assess their profit into tax, it will be from the day they have commenced business to 31st December of that accounting year. So from commencement date to 31st December of accounting period. So for a petroleum company that is commencing their business maybe in the year that commence their business in the year 2025, that means their profits will be to determine the assessable profit. It will be from the day which they have commenced that business for that year to 31st December. Are we together now? For 31st December. But for companies that they are not commencing their business in that year of assessment. It's not that they are commencing their business in that year of assessment. That means they have been carrying out their business out prior before that year. That means it is not commencement that will be applied to them. That means to determine the assessable profit now, it will be from January 1st to 31st December of the accounting year. So January 1st to 31st December of the accounting period. Are we together? That means for companies that they are not carrying out their businesses, they are not commencing their businesses in that particular accounting period. That means they have been doing their business prior before that year. That means to assess their assessable profit to tax, it will be from 1st January of that year, let's say 2024 now. Maybe we are going to assess them for 2024, it will be 1st January 2024 to 31st December of 2024. But let's say a company that starts their operation, that means they are commencing their operation let's say in 1st April in 2024. That's when they started their operation. That means 1st April 2024. That means if you want to assess their profits in the year 2024 now, it will be 1st April 2024 to 31st December. That is for commencement date to 31st December of the accounting period. Now let's now go to company that cease operation. Cease means that they are ending their operation for that accounting year. How do you assess them to profit, or how do you assess them to tax in that year which they have ceased not to operate? Now this is how you do it. It will be from 1st January to when they cease their operation. First, from January 1st to the last day, to the last day the company, to the last day the company cease. Let's say a company now, a petroleum company, they now say they are ending their operation in the year 2024. Let's say the year 2025. They say they are ending their operation, and the year in which the date at which they are ending their operation in the year 2024, that means they are not doing again. They want to close up their operation. That means they want to fold up now. Let's say the date is 31st October 2025. 31st October 2025 is the year in which they cease operational. So how do you assess them to tax now? How do you assess them to tax? Now this is how you assess them to tax. They said from January 1st to the last day the company cease operation. So what's the last day they cease operation now? Based on this scenario I'm giving, the last day they cease operation is 31st October. That means their basis period will be from 1st January 2025 to 31st October 2025. That's how to calculate it now. That means the revenue you are doing within this period is what you are going to what subject to tax. So you need to determine the accessible profit within this period. Now let's move forward now. Let's move forward. Now let's go to tax, charge to tax. Charge to tax. So we have talked about this. So I'll wipe up this. Should I wipe up it? Now let's go to charge to tax. Oh God. You should have asked the question. So let's go to charge to tax. Charge to tax. Now, it is the profit of companies that engage in upstream operation. Are we together now? That are engage in upstream operation that we charge to hydrocarbon tax. Are we together now? That means companies that engage in upstream petroleum operation that pays what hydrocarbon tax. Are we together now? They pay hydrocarbon tax. They also pay company income tax. But we are going to look at that. We'll calculate that differently. So it is you charge companies that operate in hydrocarbon that operate in upstream operation to hydrocarbon tax. So let's move forward now. Let's move forward. Now let's. Sorry, wait. Please. The network is somehow. The thing you said upstream and operation. Companies that engage in. So charge to tax It is companies that operate in an upstream petroleum operation that pays what hydrocarbon tax, and they pay hydrocarbon tax in relation to the crude oil, in relation to the profit they have made from what, from that upstream operation. That means the extraction and exploration of crude oil. But they pay company tax on what, on their global what profit. That company may actually buy shares. That means that shares cannot be taxable under hydrocarbon tax because it's not related to upstream operation. But under company income tax, it will be charged to what, to tax. Are we together? Now let's now continue. Now let's now go to allowable deduction and non-allowable deduction. That means when you are calculating the expenses, when you are calculating the adjusted profit of companies that engage in upstream operation, and you want to tax them to hydrocarbon tax, there are some what? There are some allowable and not allowable deduction. So let's look at allowable deduction and not allowable deduction. So allowable and not allowable So let's quickly rush through the allowable deduction. When we say allowable deduction, they are deduction that the tax law recognize. They are deduction that the tax law recognize. They are deduction that can be allowed in the computation of hydrocarbon tax now. Are we together now? Now let's now look at it now. We have rent incurred by company. That rent incurred now must be rent that is related to what? To petroleum mining lease. You know, you pay rent on lease or petroleum prospective what? License. Don't forget. So if they rent an apartment that is not under upstream operation, that means the rent they have incurred for petroleum mining lease or petroleum prospective what license. So those rent that they pay is what is allowable to what? To tax now. So if they pay royalty, that means royalty that they pay, you know, when they discover crude oil now, you may need to be paying royalty to the federal government. They will give you the land for exploration of crude oil and you will be paying royalty. And this royalty serves as a means of revenue to the federal government. So all royalty and the liability for which was incurred and was paid by company, I will say that in respect of crude oil or associated with gas is an allowable deduction. Now, expenses incurred for repairs of plants, maybe the plant equipment that are using to carry out the exploration or extraction of crude oil. Those plants, those equipment that are using of fixtures that they are using to carry out their upstream operation, it is an allowable expense. So repairs. So if they carry out a repair that is not related to what? To production activities for for upstream operation, it cannot be what? Allowed. Now, also look at it now. Any expenditure they incur now, an expenditure on tangible and intangible, look at it, that is related to what? To first exploration well and the second two assessment well in the same field. Look at it now. What they are saying that if you you incur an expenditure now, whether tangible, untangible expenditure or intangible expenditure now, for appraisal, are we together now? Are we together? For drilling, yeah, for drilling of first exploration well, it is allowed. And for the first two appraisal well, it is what? Allowed. So after that two, if you now incur any expenditure on maybe the third, fourth, those expenditure will not be allowed. Are we together now? Any expenditure, or whether tangible or intangible, that is related to the drilling of first exploration well and first two appraisal well, it is allowed. On the same field, it is allowed. But anything beyond that, it is not allowed. Now let's continue now. So any amount, are we together now? Any amount contributed to a fund, you know, they may actually contribute money to a fund. Let's say the fund is a host community trust fund. It is also what? Allowed. So any contribution that they make to federal government, are we together? Any sum or liability which is incurred by the company to federal government or local government or state government is also allowed. So if they pay any levy now to state government or to federal government based on the activities of that upstream operation, is an allowable expenses. So like payment of stamp duty or fees, it is an allowable expenses now. So the cost of gas reinjection well, it is also what? Allowed. It is allowed. So I've explained this, any contribution made to any fund or any scheme that is approved by the commission, whether it is a host community trust funds or environmental fund or Niger Delta Development Commission and other similar contribution, is an allowable expenses. Are we together now? Now let's now go to the not allowable expenses. That means disallowable expenses, not allowed. That means a company can incur these expenses, but when they are calculating their tax, these expenses will not be recognized by the tax authority for deduction. Are we together now? So it will be added back to the profit of the organization. So it will not be allowed. So it will not be allowed for ascertaining the adjusted profit of a company now. So let's now go to any expenses or disbursement that a company has made that is not what? That is not only, that is not reasonably incurred, that is not exclusively and necessarily incurred for the purpose of the operation, is not allowed. Only means for that business. Necessary, is it necessary? Is it exclusive? Is it reasonable? Are we together now? So let's say the company now, the upstream company now is now paying donation, is now giving donation to APC or ADC now. Is it necessary? Are we together? Is it necessary? Is it exclusively incurred for the operation of that business? No. So it will not be allowed. So let's move forward. Expenditure for the purchase of information. You know, you purchase of information to know whether crude oil is present in a field now or in a facility. You are not trying to obtain information to know which area crude oil is present now. Those expenditure you've incurred, those money you pay for you to get information, are we together now? For the existence of petroleum deposit, it is not allowed. Are we together now? Any penalty that you incur, are we together? If you incur any penalty, like expenditure that you pay for a penalty for violation, maybe for emission of gas, are we together now? It is not allowed. If bank charges or financial charges or bad debt or interest on loan is not allowed, but under company income tax we may allow interest on loan, finance cost, but under calculation of hydrocarbon tax, all this is not allowed. Financial and bank charges, litigation costs, bad debt, it is not allowed. Even litigation cost is not even allowed in what you call in company income tax. But let's continue. They say head office or affiliate cost. That means any cost that the head office is incurring, are we together, that is not directly related to the production, it is not what? Allowed. Maybe any expenses that they incur, whether it is research or development cost, that is not directly related to what? To production, it is not allowed. Are we together now? Production bonuses or signature bonuses, this is what they pay for the acquisition of rights. Are we together now? Is not allowed. Any production bonuses they pay or signature bonuses that they pay before acquiring what? A right, for the acquisition of a right over a petroleum deposit, it is not what? Allowed. Are we together now? Now, any tax inputted into a contract, all these lease is a contract, into a contract or an agreement are on a net tax basis paid by the company is not allowed. On behalf of a vendor is not allowed. Are we together now? Maybe they put company income tax and they pay company income tax of 2024 now in 2025. They now say the company income tax they have paid now. That company income tax now is not what? Is not allowed. Or withholding. They paid withholding on behalf of, let's even say withholding. They paid withholding on behalf of a contractor. Now it is not allowed. Are we together now? So any tax inputted into a contract or an agreement is not allowed. Are we together now? Capital withdrawal, withdrawing from the capital, drawing is not what? Is not allowed. Any capital improvement, are we together now? That is separated from repair. Let's say that we have overhaul, maybe you change the engine of a car. That's not repair, it's an overhaul. Are we together? To improve the efficiency of that car is not mainly repair. Repair are maybe expenses, small expenses on the car, maybe the battery, you have to change the tire and all those things. They are or the engine oils. But when you are changing the engine now of a car, that is what we call capital employed in improvement. So it is not allowed because capital allowance will be given in respect of that. That means any amount that a company incur that can be recovered through insurance, the insurance has covered it. Maybe something gets spoiled, but that thing that got spoiled now, it has been insured. So the insurance company are going to pay for it. So even though you use your money, you are still expecting money from the insurance company to cover for that expenses. Any expenses that insurance covers, are we together, is not allowed. Now, any rent or cost of repairing any premises that is not related to upstream operation, it is not allowed. Maybe they are rent on their head office now, is not allowed. Because that is not directly related to what? To the extraction or exploration of crude oil. Are we together now? Now, they said any amount incurred in respect of treasury, education tax, company income tax, profit tax, it is not allowed. So you can't say because you pay tax, you now deduct it from your profit. The tax authority will not recognize that. Also, depreciation on premises, depreciation on equipment, on furniture and fixing plant is not allowed under. So any custom duties is not allowed. Are we together now? Any contribution that is not approved, okay, that is not approved by the commission or by the Petroleum Industry Act is not what allowed. So let's now move to let's now move to capital allowance. Capital allowance. I'm coming on. Capital allowance. Is there any question? Now let's go to capital allowance. Capital allowance is companies that is operating in an upstream operation can also claim what capital allowance. You know, the under the non-allowable expenses, we say depreciation is not what allowed. That means because the reason why depreciation is not allowed in tax generally is that, you know, there are different methods of solving depreciation. So if you use straight line method, reducing balance method, and any of the method, if I acquire an asset of 1 million now, if I acquire an asset of 1 million, let's say I acquire an asset of 1 million. Now, if Mr. B acquire an asset of 1 million, Mr. B too acquire an asset of 1 million. Let's now say Mr. A is using straight line method for his depreciation for that asset, and Mr. B is using reducing balance method for reducing balance method for the depreciation. That means each of the year of calculating depreciation, they can't have the same amount, even though they bought the same asset at the same price. So because of this inconsistency, that's why depreciation is not allowed, and that's why the tax authority comes up with what? With capital allowance. So if you acquire the same asset at the same price, you will enjoy the same what? Allowance. The same what? Capital allowance. Now let's now go to capital allowance. Capital allowance is given in lieu of what? Depreciation. It's actually claimable on qualified capital expenditure. That means what do you mean by qualified capital expenditure? Qualified capital expenditure are expenditure. They are expenditure that is incurred on what? On asset that will take substantial period of time to be what? To be used or to be ready for use. So, like plants now is a qualified capital expenditure. Machinery is a qualified capital expenditure. Are we together now? Now, the capital allowance that these upstream companies are claiming, they are capital expenditure that is related to what? To petroleum what? To upstream petroleum operation. Now let's now look at how do we now calculate capital allowance. Now we have petroleum company can claim capital allowance on plant expenditure. They can claim capital allowance on oil pipe and storage expenditure. They can also claim capital allowance on building expenditure. Are we together? That means they are permanent structures now for the upstream operation. All these things must be related to what? To the upstream petroleum operation. They can also claim capital allowance for drilling expenditure. Are we together now? Drilling, maybe they need to get some equipment for their drilling operation now. Those equipment now they are getting for drilling they can claim capital allowance on it. So they can claim capital allowance on plants, machinery, features for their upstream operation. They can claim capital allowance for pipeline and storage expenditure. You know, they will have an asset. They will have an asset where that crude oil will be stored into. Are we together? or a system where the crude oil will flow into a storage facility. That storage facility or that floating production system is an allowable expenditure. So we also have for building that is related to the upstream operation, and we have drilling expenditure. So they can claim capital allowance on qualifying plant expenditure, qualifying oil pipeline and storage expenditure. They can claim capital allowance on 3 qualifying building expenditure, and lastly we have qualifying drilling expenditure. So let's now go to types of capital allowance claiming. Types of capital allowance claiming. So we have annual allowance, annual allowance. Now, how do we calculate annual allowance? The annual allowance is given for 5 years. Now, it's given for 5 years. That means for the first 4 years, of acquiring that qualifying asset or incurring qualifying capital expenditure for the first 4 years, you charge 20%. So 20% of the cost of that qualifying capital asset or expenditure, 20% will be claimable for you to use it to reduce your profit. Are we together? So if you use it to reduce your profit, that means the tax that you pay for that year will reduce. So the first year you can use 20% of the cost of the expenditure. The second year 20%, the third year 20%, the fourth year 20%. So the fifth year now, are we together? The fifth year, it will be 19%. It's not 20%, 19%. Now if you calculate it now, 20% in 4 places, that's how many? 80%. So you claim 80% of the cost of that qualified capital expenditure. Now the fifth year you claim only 19%. Now 1% that is remaining, because if you add 80 plus 19, that will give you 100, will give you 99. So the 1% is for you to retain that 1%. You retain the 1% in the book until the asset is disposed. Are we together? So let's now go to 2. You also have what we call balance adjustment. Balancing adjustment. Now you can claim capital allowance on an asset. Let's say, let me give an example. Look at it. If the tax written down value is lesser, this is lesser than the sales proceed, you can claim what we call, you can claim allowance on it. I will say that will be balancing allowance. Let me give you an example. That is what determines balancing adjustment is that when a qualifying asset is being disposed, that means you want to sell an asset. Let's say your plant or the machinery that you are using for your upstream operation, you want to sell it. Now, if the tax written down value of that asset, let's imagine is 20 million. And the sales proceed is 15 million. That means the tax written down value is okay, sorry. The tax written down value, this is greater than that. This is less than. The tax written down value is greater than what? the sales proceed, the tax authority will give you an allowance, balancing allowance. The balancing allowance will now be the difference between the tax written down value and the sales proceed. What is the tax written down value? What is the difference? 5 million as balancing allowance. But now let's now imagine that the sales proceed is 35 million. Can you see that the sales proceed is greater than what? Than the tax written down value. So they will not give balancing allowance, they will give what we call balancing charge. So that balancing charge is not an allowance, it will be added to your revenue. So you now pay an extra what? Tax on that income because they believe that you have made a profit from the sales. Any question on this? Together now. If what balancing adjustment is just looking at is focusing on the differences between tax written down value and sales proceed, that it can either result to balancing allowance or balancing charge. Look at it now. Whenever the tax written down value, that is the value of that qualified asset, is greater than the sales proceed. Let's say the value is 20 million. What the value of that asset is 20 million. But how much the sales proceed, the price at which you sell it was 15 million that you made from that sales. That means you have made a loss because something that is worth 15 million now is now being sold for that is worth 20 million, now being sold for 15 million. You have made a loss of 5 million. That 5 million will be given as allowance to relieve you. So it's called what? Balancing allowance. But let's now imagine that the sales proceed is 35 million. Now you can see they say the value of that asset is 20 million, but you have now sold that asset or those qualifying asset to 35 million. That means you have made a gain from it. How much is the gain? So that 15 will now be not, they will not give allowance on it. That 15 million, they will not give allowance on it. They will not give what they will not do that. It is now assumed that you have made an additional income. So that income now will be added to your profit. So that to increase the amount or to increase the amount of tax that you pay. That is what they call it, balancing charge. No, it's not far. It's because this class is echoing. That's why that's the reason why it's sounding like that. I believe there are people in the class, it will not be sounding like that. So, am I closer now? So now, let's now move forward now. Let's look at this example. Baba tea. Let's look at this example. Baba tea. So let's look at this example. Let me cancel. Let me wipe up. Page 140 what? Sorry. 145 of our material. That's what I'm looking at. So example 1 under it. Example 1. Now they say Babati Petroleum Company Limited. Babati Petroleum Nigeria Limited has a petroleum mining lease and operate both in onshore and shallow water area in the Niger Delta region of Nigeria. The company qualified capital expenditure schedule for the year ended 31st December 2024 review the following. So we have the date of acquisition 1st November 2019 for building, which is $25,000. 15th January 2020 pipeline and storage is $17,300. 14th April, that is the year of acquisition, 2021 plant, the price or the cost is $12,700. We have 6 March 2023, that's the year of acquisition for drilling expenditure, which is $6,000. We have 20 December 2024 pipeline storage, $19,500. They now say compute the annual allowance claimable by the company for the purpose of hydrocarbon tax in 2024. So let's look at it now. They said we should calculate the capital allowance claimable. So let's calculate the capital allowance claimable now. So computation and Baba T Nigeria Limited. So computation of annual allowance claimable. Are we together? Claimable. So look at it now. How, when I was explaining to us, how did I explain it? I said for annual allowance that the first 4 years will be 20%, while the 5th year will be what? 19%. Are we together? So let's look at the date of acquisition. Date of acquisition. Date of acquisition. The qualifying capital expenditure. What is the qualifying capital expenditure we are looking at? Are we together now? The cost and the rate and the annual allowance. Are we together? Now, for the first asset, when was it acquired? It was acquired in 1st November 2019. And we are in which year? We are in 2020. Look at it now. We are in which year? 2024. So 2019, 2020, 2021, 2022, 2023. Are we together now? Yes. The first year is what? The year in which it was acquired. That asset was acquired was when? Was 2019. So 2019 we charge 20%, 2020 20%, 2021 20%, 2022 20%, and 2023, which is the 5th year, we charge what? 90%. In 2022, are you going to charge anything on it? What? Will there be capital allowance claimable on it? In what year? In 2024, what we are calculating is the computation of annual allowance claimable for what? For year 2024. So let me just for 2024 year. Look at it now. Look at this. It was acquired in 2019. We have 2020. 2021, 2022, and probably 2023. And what we are looking for is 2024. Now, the question is, the tax law says that you can claim what? 20% in the first 4 years. This is the first 4 years. 1, 2, 3, 4. You can claim 20% of the cost. So 20% will be claimed in 2019, 20% will be claimed in 2020, 2021, 20%, 2022, 20%. Now, the fifth year, 20% of the cost will be claimed as capital allowance. Can you hear me now? Now, in 2023, which is the fifth year, he said the annual allowance will be 19. The 1%, because if you add all this together, it will give you 99. So they said 1% of it should be retained till when the asset will be disposed. So look at this asset now. In 2024, will you claim any capital allowance on it? So there is no capital allowance now. So let's just put that. So what the capital is building, right? So building, what's the cost? $25. So the rate, new. So let's go to 2 now. There was asset was purchased in where? Was purchased 15th January 2020. Now, that means, look at it now. If it's purchased 2020, it means 2020, you claim capital allowance for 20% of the cost. 2021, 20% of the cost you will claim as capital allowance. 2022, 20% of the cost you will claim as capital allowance. 2023, 20% of the cost will be what? Will be claimed as capital allowance. 2024 now, which is the fifth year, what are you going to claim? 19%. So 19%. So what's the pipeline and what? And storage. What's the cost? 17,300. So if what is 19% of 17,300? That will be 3,270. So let's move forward. Let's go to number 3. When was it acquired? So it is the gate of acquisition that will enable you to determine which rate, whether to charge 19% or 20% now. So let's go to first to the third one. It was purchased date of acquisition is. Hold on. So I will get that. So if you look at it now, year of acquisition is 2021. So if you calculate 2021, 2022, 2023, 2024. So the 2024 is the fourth year of the fourth year when the asset was acquired. I wish we had from the year when the asset was acquired to 2024. 2024 now is the fourth year. So we charge 20%. So it's planned, this is the cost. So 20% of the cost will give us 2,540. So let's go to number 4. So number 4 is when was it acquired? 6 March 20. So automatically we should know that 2024 falls within the first 4 years. Yeah. So what are we going to use? 20%. So what is the qualifying drilling? Drilling. So what's the cost? 6. So 20% of 6,000. That means 1,000. So 1,200 will be the capital allowance that they will pay. So let's go forward. So let's go to the 5th. So when was it acquired? 20th December. So 2024 is the first year of acquiring the asset. Pipeline. So what's the cost? The cost is 19,500. So now, which rate are we going to use? 20%. Because if you count it 2024, and we are claiming the data amount for 2024. So that is 2024, that is 20, that will just 20%. So 20% of the cost is how much? That is 3,900. So what is the total claimable allowance in 2024 now? So we add all this together. Okay. So let's add it together. So 3,287. 3,287 plus 2,540 plus 1,002 plus 3,900 will give us how much? Total. That will be 10,000. 10,000 what? So this is the total annual allowance that is going to be claimed in 2024. So any question?